Hello everyone, I'm Kingston, working as an assistant professor of Department of Commerce, Vivo Chidambaram College. I'm so happy to meet you all once again in a different topic in the 10 days of crash course in net and set. At first, I would like to apologize for the inconvenience because I'm unable to show my video due to some technical difficulties. But I'm sure that this session is going to be helpful for you to brushing up all the basic concepts that you know about banking and financial institutions. In the next syllabus, there is a unit called Banking and Financial Institutions. When we talk about banking and financial institutions, we have to talk about the financial instruments as well, like the financial assets. When we talk about financial assets, we have to discuss the place where it is being traded, that is financial markets. So we have to discuss banking and financial institutions, financial instruments, and the financial market. When we talk about these three different elements, we have to mention Indian financial system as well. The very first chapter of this particular unit is called Indian financial system, which completely covers the entire unit and a comprehensive outlook. So I decided to give you about Indian financial system in a capsule form, and I'm sure that it will definitely give you ways in understanding it completely. So what is financial system at first? Financial system, it's a vital role for any economy or in any country, and it is an institutional framework of three different important elements, as I mentioned before. It has three major parts, which are financial assets, financial institutions, and financial market. And the institutional framework of these three components that exist in a country, which enable the financial transaction to happen very smoothly and very effectively and efficiently. What is financial asset? It covers both short-term and long-term financial instruments like loans, deposits, bonds, equities, treasury bills, commercial papers, certificate of deposits, and all those financial instruments. What is financial institutions then? When we talk about financial institutions, we have to talk about both organized sector and unorganized institutions. What organized institutions are highly regulated. It has special set of rules. It has a special regulatory body. And when we talk about the unorganized sector, we have to go back to the 1920s, where the financial setup was not highly organized and highly regulated. So at that time, the unorganized financial sectors were the money lenders, local bankers, traders, landlords, and fund brokers. And they were serving as a financial institution way back in 1920s. And now the financial institutions are highly regulated, and it comes under the umbrella of the regulatory bodies like SEBI, RBI, IRDA, and all these financial institutions. And then, of course, it is under the regulatory bodies as well, but those institutions are also can be called as financial institutions in all the banks, including RBI. The third component of financial system is financial markets. It covers money market, capital market, and forex market, and of course the commodity market, MCX and MCDX. So all these three important elements make the financial system, and which enables the financial transactions to happen in a particular country smoothly and effectively and efficiently. Now, what we are going to see today is about financial system. And as I mentioned before, financial institutions, we have to talk about financial banking and non-banking institutions. In financial markets, both unorganized sector is there, organized sector is there. But today, in the modern world, everything has become so organized. So we will be discussing money market and capital market under financial markets. And financial instruments, I'll discuss both the instruments which are traded in capital market and the instruments which are traded in money market. Financial services, we'll not be discussing too much depth in detail, but then we'll have a glimpse of it. So with the overview of what we are going to discuss today, and we'll step on to the other slide. What is financial asset or financial instrument? And typically we would normally call this financial avenues. Financial instrument is a claim against a person or an institution for payment at a maturity period or at any future date with the sum of money or periodic payment in the form of interest or dividend. Any instrument which has a kind of special maturity period or anything which is cost associated like interest or dividend can be called as financial instrument, which enables channelizing the funds from surplus unit to deficit unit. You know, the persons who have money in their hand, they want to invest it or they want to save it. The person who wants to save it, put it in a deposits like equities and mutual funds. You know, normally the people who want to save money, they want to put it in a bank so that their surplus money earns certain amount of savings. When it is highly risk associated, and those savings will be termed as investments. So the surplus of money, either it is getting a form of savings or it is getting a form of investment. So the one who's having surplus unit, it is being transferred to the people who are in the need of money. So what channelizes those kind of activities called as financial instruments. So financial instrument, it enables channelizing funds from surplus unit to deficit units. So there are certain instruments for savers, and of course there are certain instruments for borrowers. Even people who borrow through financial instruments are even being businesses or governments. Governments also raise funds through issuing bonds and treasury bills. If governments want any money, if they are running short of money, they'll issue treasury bills, which will be raised, which will be issued through RBI. So people whoever buys it, they'll have a surplus money. The people who buy it will give money to the RBI, through RBI the government is getting benefited. So obviously the government is running under deficit unit. People who give money through buying treasury bills are sending a surplus to government. So the financial instruments are which channelize the funds from surplus unit to the deficit units. Instrument like Public Provident Fund and Kisan Vikas Patra, that is KVP, are also available to savers who wish to lend money to the government. Public Provident Fund is also a kind of money that we lend to the government. And there are differences to Public Provident Fund and Kisan Vikas Patra. In PPF, we give 12 percentage. It is being given. Is being deducted from our salary, so that is being paid to the government. It's both employee and employed. They contribute certain amount towards PPF. The interest charged is 7.1% at present, but in KVP it is 7.5%. KVP, again I repeat, Kisan Vikas Patra. There are certain differences between these avenues, and PPF is not transferable. Public Provident Fund is not transferable, wherein KVP, which is Kisan Vikas Patra, is transferable between post offices and between persons. Normally KVP is opened in post offices, but it is purely transferable between the branches as well and between the persons as well, but PPF is not transferable. So these are avenues for the savers who wish to lend money to the government, through which the government is getting benefited. So financial instruments are channelizing funds from surplus unit to deficit units. And there are certain instruments for savers and there are certain instruments for investors. When we talk about financial institutions, we have to talk about the mechanisms as well. It includes it affects the generation of savings by the community. Of course, financial institution has been affecting the generation of savings by the community, in which for 50 years later, before, when we were talked about savings, it was only about bank savings. But now when we talk about savings, the saving arena has been diversified in many areas. Even we can save money in insurance, we can save money in post office, we can save money in banks. Even in NBFCs, there are certain schemes, so through which we can save money. The patterns of savings have completely got changed. It has affected the pattern of savings uh, through the financial institutions. It has got a dramatic change. Mobilization of savings. Of course, when we save money and the funds are being mobilized to one end to the other end. So financial institutions facilitate that kind of mobilization of funds to the people who are having surplus, to the people who are in the need. And third one is effective distribution of the savings. When I have money in my hand and now I put it in the savings, so what banks are doing, it gives it to the borrowers of loans. So the money that I have is being given as a loan to the borrowers. The borrowers invest it somewhere, or they use it for their own purpose, so through which the idle money is earning certain amount of appreciation to it, through which the effective distribution of saving is possible. Institutions of banks, the typical example for institutions of banks, insurance companies, and mutual funds, which mobilizes savings. Then individualist investor can also be the part of it. For example, if I want to invest something, or if I have the surplus of funds, I'll be termed as an individual investor. So even industries, even trading companies can be the borrowers, and of course they can also be the savers. What is financial market then? Financial market is basically or a mechanism enabling participants to deal with the financial claims. As we know, market is a place where certain goods or services are being traded or exchanged. Similarly, financial markets are the place where the financial instruments are being traded and sold or exchanged. So some financial instruments will be exchanged, some financial instruments will take birth at the place. So it will be traded to someone else. So one person to another person, whatever is being exchanged or traded, that place will be called as financial market. And all the financial instruments will take birth at markets, and it will be traded and exchanged over there itself. So financial market also provide a facility in which their demands and requirements interact, where the demands and supply met together. That's where the price fluctuations takes place. So financial market facilitates the price volatility as well. So what is being traded in financial markets? Both money market funds, money market. When we talk about money market, all the instruments that are being traded in money market will have a maturity period of 1 year or less than 1 year. What is capital market? Capital market is a place where the long-term financial instruments are being created and traded. That's where the primary issue market and secondary market, stock market and bond market will be coming into the picture. Primary market, where the IPOs are taking place, initial public offerings are taking place. Stock market or secondary market, where the instruments which took birth in the primary markets are being traded and sold. So even organized banks are taking or being a place where the instruments are being traded. Unorganized sector, as we talked about earlier, the money lenders, cheat funds, and landlords and pawnbrokers, and they were all a part of. They were having a kind of market, and they were serving for people who are living around. So they were also called as unorganized financial markets, and those are not very popular now, and there are very few are doing it in Mumbai and other area. In capital market, it still happens, but in the other areas, it's not quite a familiar one. Organized money market. Money market, we have to understand the fact that money market has no physical market. Even some of the markets are being traded over the phone as well. In India, basically, in three places there are money market centers are there. First, the financial capital of India in Mumbai, there is, and Delhi, and in I think one more place is there, but there are three places in which the money market is working very effectively. And an astonishing fact is that money market gives nearly 2 to 3% of GDP. It contributes in GDP nearly 2 to 3%. In 2016, it was 2.3%. So, what is money market at first? Money market is the place where the financial instruments which have the maturity period of 1 year or less than 1 year take place, or are created or being traded. Call money market. It deals with the very short-term kinds of loan arrangements. Bill market, it talks about treasury bills and commercial papers. We'll be discussing one by one in detail. And bank loan, it also it's very short term, less than 1 year. So organized money market comprises of RBI, banks, commercial and cooperatives. Unorganized money market is also there, but it's not quite popular. Purpose of money market. What is the purpose of money market? Banks borrow in money market to fill up the gaps of temporary mismatch of funds. Now, we might know, we should know that in call money, all the banks are being traded. It is the financial arrangement between the banks to exchange the surplus money between the banks. So bank are the only main participants in call money, exchange. So it fills the gap of temporary mismatch of funds between the banks when they are dealing with call money market. So banks are the main participants in money market instrument. To meet CRR and SLR mandatory requirements as stipulated by the central bank. As we know what is CRR and SLR, CRR is cash reserve ratio and SLR is statutory liquid ratio. CRR, cash reserve ratio, it means that a certain proportion of money has to be kept in RBI by the commercial banks. A certain portion of money has to be deposited by the commercial banks with RBI. Why is it required? Because that proportion will be based on the deposits of the banks. Certain proportion of the deposits have to be deposited in the central bank. And why it is being deposited? Because to protect the interest of the savers, it is being deposited. SLR, the cash, liquid cash has to be deposited in RBI. So cash reserve ratio, it is purely the cash, but in SLR, it is the liquid cash like gold and other financial instrument which are highly liquid has to be deposited in the form of gold or any other financial instruments in order to protect the interest of the deposit holders. And these are very mandatory. And to meet those requirements, money market banks are participating in money market instruments. And third, to meet sudden demand for fundraising out of large outflows. When banks spend too much of money for example, for like tax advance payments, suddenly it would need a large amount of money to run their operations very smoothly. At that time, it can go for the call money market to match up their temporary mismatch of funds. Call money market serves as a role of equilibrating the short-term liquidity position of the banks. Liquidity position, the word liquidity, it means, anything that can be convertible into the form of cash within the stipulated period of 1 year. So if a particular bank is highly liquid, it means that it has enough cash, and it has enough liquid cash like gold and other short-term financial instruments. So this is the purpose of money market. Money markets are the facilitators for banks to fill up the gaps of temporary mismatch and to meet the CRR and SLR mandatory requirements, and to meet the sudden demand for fundraising. Call money market, as we discussed a little bit earlier, I know it is an integral part of Indian money market where day-to-day surplus funds, I mentioned just now, it mostly banks are being the participants of call money market. So so banks participate in that particular market to manage the day-to-day surplus of funds. Loans are of short-term duration, 1 to 14 days. Money lent 1 day is called as call money. So call money, it is purely for 1 day maturity period. It is being given for overnight. If it is exceeding 1 day, but it is less than 15 days, it is called as notice period. So notice money. Money lent for more than 15 days is called term money. So in money market, there are three different instruments based on the maturity period. First one is called as call money, which will be given for overnight, just for 1 day, and the other one is for notice money, which will be more than 1 day but less than 15 days. Money lent for more than 15 days is called as term money. So the borrowing is exclusively limited to banks, and I and you, people like individuals, cannot go into it. Only banks are having the access to this particular call money market. Call money market, or loans are generally made on clean basis, that is, no collateral is required. And collateral based loans are not given in call money market. It is only based on the demand and supply. So based on which the interest rate is fixed. Okay, so basically these are made of clean basis where there is no collateral is required. The main function of call money market is to redistribute a pool of investment to day-to-day surplus funds of banks among the other banks and temporary deficit of funds. As we said before, the instruments are the ways where through which the surplus is being transferred to the to the people who are in deficit. So it redistributes a pool of investment of surplus funds to the people who are in the deficit of funds. So call money market facilitates and mobilize those kind of funds which are in surplus to the people who are in the need. So here the people I refer as banks. The call market helps banks to economize their cash and yet to improve their liquidity. If any bank, it falls short of cash, the liquidity portion that the bank has is very less. Liquidity is something that is being decided by the cash or the cash equivalents which the bank has. So if it comes down, the liquidity portion is being questionable. So in that particular situation, call money market helps to economize their cash and cash equivalents to improve their liquidity of the banks. It is completely competitive and sensitive market because it deals with the highly liquid money, and less than the maturity periods are very less than a month. So it is highly sensitive. Anything that touches, a money market, if there is any risk, I'm sure that it would affect the entire financial institutions, exclusively banks. It is a good indicator of the liquidity position of any banks. Call money market participant. Who is a participant of call money? 90% of money market participants will be banks, like RBI and banks like primary dealers. Once upon a time, select financial finance, the financial institutions which are selected by IDBI and UTA were only allowed to participate in the call money market. But now the situation has got changed after August 2005. That many banks which were in the earlier phase were phased out of money market. Now it is purely interbank market, and only the banks are being the part of money market participants. Development of money market. Prior to 1980s, the participant depended heavily on the money market, called money market. And apart from this, I would like to tell you one thing, that in the year before 1989, there was no, sorry, 1985, there was no regulatory authority to monitor money market. And later, you know, uh, in 1985, the Chakravarti Committee has been formed to, make frameworks to manage money market, and through which, out of that, in 1987, certain frameworks were decided. The volatile nature of call money market led to the activation of the treasury bills market to reduce dependence of call money. So the emergence of market repo and collateralized CBLO, which we call as collateralized borrowing and lending obligation instruments. The development of money market has been so tremendous. As we said before, money market instruments were not collateralized. It was purely based on the demand and supply of interbank transfers. But now later, recently, very recently, after 2000, we have got CBLO, which means collateralized borrowing. If you want any borrow, you have to submit an asset for your borrowings, and that has got emerged after 2000, and which is collateralized borrowing and lending obligation. So turnover of call money declined, but later it picked up, and now the money market instruments are being traded for 1 lakh crores, 1 lakh crores literally. Okay, and but it was only 21,725 crores in the year 2006 to 7, but now it is more than 1 lakh crores that it contributes. And as I said before, it contributes 2% to 3% of our GDP. So without money market, we might lose 3% of our GDP. Bill market. It just talked about treasury bill. Treasury bills are very secured in nature. It is highly secured because we deal with government. Treasury bills are normally issued by the government of India through RBI, and the maturity period is very less. And as we said before, all the instruments which are traded in money market will have a lesser maturity period. It has 91 days, 182 days, and 364 days as the maturity period, which is 3 months, 6 months, and 1 year. It is an IOU of the government, which means IOU means I need to give you money, which means it is a promissory note. In every promissory note, there would be a statement that I promise to pay a certain amount of money at a particular expiry date. So which means that I owe you money on a particular stipulated period. So it is a promissory note which promise to pay a stated amount after expiry of the stated period from the date of an issue. So one day to another day, which means if 1st April to 30th April, if the treasury bills are issued, not 30th April, 1st April means that 91 days. So 3 months later. So it is a promissory note basically, but the government promises to pay a certain amount to the investor after a particular period, and those periods of 91 days, 182 days, and 364 days. But normally, these treasury bills are issued at discount and redeemed at par, which means if a face value is 10 rupees, if a face value is 10 rupees, and it won't be given for 10 rupees, it will be discounted only the investor will pay 8 rupees. So 8 or less than 10 rupees, So it will be issued in discount, but redeemed at par. They'll get only 8 rupees. When they redeem the particular promissory note, they'll give you 10 rupees. The difference is what we call as profit. So normally it is issued at discount. RBI auctions 91-day treasury bills on a weekly basis. Once in a week, it auctions 91-day bills, or 2 weeks once, which means on a fortnight basis. Fortnight basis, which means 2 weeks gap, it issues 182-day treasury bills and 364 treasury bills. And money market instrument. As we said before, money market instruments are those which have maturity period less than 1 year. The most attractive part of money market is the market for overnight call and term money. We know what is overnight call. It is call money. What is term money? The money which exceeds more than 15 days of maturity. Between the banks and institution and repo transaction, repurchasing transaction. Call money, repo are very short-term money, are very short-term money market products. Call money, which means just for 1 day, which is given for just 1 day or overnight basis. Money market instruments. What are the money market instruments? Which means what are the instruments which have less than 1 year of maturity period? And these many instruments are there. Certificates of deposit, and these are all in our syllabus as commercial paper, interbank participation certificates, treasury bills discounting, call money and notice money, collateralized borrowings and lending obligations, which is called CBLO, collateralized borrowings and lending obligations, and market repo. Certificate of deposit. What do you mean by certificate of deposit? Many people confuse certificate of deposit with fixed deposit. No, but certificate of deposit is transferable basically, but fixed deposit is not transferable. Certificate deposit are short-term borrowings issued by all the scheduled banks and are freely transferable by endorsement and delivery. As we normally endorse our checks for transfer, we can also endorse certificate of deposits, but it's not quite possible in terms of fixed deposit. It is introduced in India in the year 1989. Maturity is not less than 7 days. And now you cannot find a certificate of a deposit which is not less than 7 days. It's just 1 week. But wherein the call money, it will be issued even for fortnight basis. Sorry, even for overnight basis. Even financial institutions are allowed to issue certificate of deposits for a period of between 1 year and up to 3 years, and it is little short term. Even for 1 year you can issue, but even 2-3 years the financial institutions can give. And the payments are subject to stamp duty. The stamp duty have to be paid under the Indian Payment Stamp Act 1899. And commercial deposits can be issued to individuals as well. It can be issued and to individuals, corporations, and trusts, and fund and associations. They are issued at a discount and freely determined by the market and investors. As I said before, like treasury bills, it is also issued in discount, which means lesser than the par value it is being issued. And what is more about commercial paper? The short-term borrowing by corporates, financial institutions, primary dealers from the money market. Whoever is being a part of money market, they can buy it, but not the individual buyers. But normally it is being given by, the institutional buyers also can buy it, but not typically it is being given to them. But normally what people are buying commercial papers are corporates. Can be issued in the physical form. UPN. It will be issued in the form of UPN, Usance Promissory Note. Usance Promissory Note is nothing but the instrument which has a physical form, not in the electronic form. But also it is being traded in the demat form as well. It is introduced in the year 1990. When it is issued, the physical form are negotiable by endorsement. If you have a piece of paper and if that paper is called a certificate, a commercial paper, it is still negotiable and you can still endorse it. And it is highly flexible. Issued subject to minimum 5 lakh and in the multiply of 5 lakh. In certificate of deposit, the minimum requirement to invest is 1 lakh. For certificate of deposit, the minimum requirement to deposit is just 1 lakh. But wherein for commercial papers, the minimum amount in which the fund is raised is 5 lakhs, and only the multiples of 5 lakh after it can be charged. The maturity period is less than 7 days to 1 year, unsecured and backed up by credit rating of the agencies. Unsecured, and which means it has no collateral, but and backed up by credit rating. Normally the blue chip companies can only issue commercial papers because only the blue chip companies will have good credit rating thing. There are credit rating agencies which rate the credit worthiness of the company. The company which has a great credit worthiness can only issue commercial papers. Normally, the blue chip companies will issue it because it is highly unsecured. So we cannot believe every investor, every companies, but we can blindly believe the blue chip companies which earn profits consecutively, which earns good amount of profit consecutively. So basically, since it is being unsecured, only the companies which have the higher credit rating will issue it. As we discussed earlier, it is issued at discount and redeemed at par. Par means face value. Market repos. Repo is called as a repurchasing agreement, and it is an instrument that enables collateralized short-term borrowing through the selling of debt instrument. And it's quite self-explanatory. And it is an instrument that enables collateralized short-term borrowing through the selling of debt instruments. The security is sold within an agreement to repurchase it at a predetermined date and rate. For example, when I sell something, I agree to repurchase it after the particular period of time. So that thing is called this repo, which means repurchase agreement. So reverse repo is a place that is completely a mirror image of repo, which means I sell something to buy it later is called repo. But I buy something to sell it in future is called reverse repo, right? So reverse repo is a complete replication of repo. CBLO, which means collateralized borrowings and lending obligations. It was launched by CCIL, which means Clearing Corporations of India Limited. Clearing Corporations of India Limited in 2003. It is purely an online trading system. On the lender side, the main participants are mutual funds and insurance companies. All the CBLOs are participants, which means collateralized borrowings and lending obligations. Normally, banks are doing it, and even banks are being diversified to banks have diversified its operations to the mutual funds as well. The major borrowers are nationalized banks and non-financial corporations, which means NBFC, non-banking financial corporations. So these two are the main participants of the CBLO, which means collateralized borrowing and lending obligations. Indian banking system. Indian banking system have many kind of banks. Central bank, which is the Reserve Bank of India. For us, it is Reserve Bank of India. Commercial banks, which deal with people like us. Cooperative banks, and the banks which are made collectively by a group of people. Banks can be classified as scheduled bank. Scheduled banks are the banks which are scheduled under the Act of RBI in 1934. Non-scheduled, it is not coming into the second schedule of RBI Act. Scheduled are the banks which comes under the second schedule of RBI Act. Non-scheduled, which doesn't come about under that particular act. Scheduled bank can be classified as public sector banks. The banks which are run by government, or which are having more than 51% of paid up share capital, is called as public sector banks. Private sector banks like TMB, like CUB, all these sector banks are private sector banks. Foreign banks, the banks which are started outside the demographic location of India, are called as foreign banks. In India, more than 33 foreign banks are there at present. Regional rural banks, and these are rural banks which support the development of that particular village or community. Indigenous banking, basically, it is a family-owned business. The capital is not from public. The capital is borrowed from the family members. Individual bankers like Shroffs, Seths, Shakers, Mahajans are combined trading and other businesses with money lending. What do? Is they combine the trading part, and they involve themselves in the other kinds of business activities. At one point, it was estimated that 1 billion met about 90% of the financial requirements of rural area. So rural area, to talk about the one more thing, is that they have nearly 10% of, 10-kilometer radius access to the particular banks. If there is a bank in village, and people who are coming to meet the manager, who are coming to avail the services of the banks, are not more than 10 kilometers away. So normally they are very near to the particular bank in rural areas, but in urban areas, it is quite, the radius area will be very few, and it will be completely less than 5 kilometers. RBI and indigenous bankers. As we said before, indigenous bankers are one who invest their own money, or they collect money from their own relatives, and it is basically would be a family-owned business. And on the Indian context, in the common parlance, indigenous bankers are traditional with a vernacular system of accounting. They're very traditional, and they are easily affectable. RBI suggested that bankers give up their trading and commission business and switch over to the Western system of accounting. RBI suggested that the banking should not, involve in trading and commission related businesses. It is also suggested that these bankers should develop the deposit side of the business. When bank, what we mean as bank, it collects deposits and gives loans. So it has to give its focus in deciding in collecting the deposits from the people. Ambiguous character of hundi should stop. Hundi just means the invoice related sales. When credit sales appears, invoices have to be created, and indigenous bankers dealt with hundi, which means the invoices related kind of transaction, which have to stop now. That's one of the RBI guidelines. And one more guidelines by the RBI is the method employed by the indigenous bankers are traditional and vernacular system of accounting, and it's not that much strong, and it is easily affected that it means. Some of them should play the role of discount houses. Discount house means where they buy and sell bills of exchange. Okay. Once the credit purchases arise, as I said before, hundi starts, which means the invoices is being generated, and those invoices are submitted to a bank, through which a certain amount of that particular invoice is being paid to the buyer, sorry, to the seller. Okay, so it is basically of buying and selling the invoices or bills of exchanges are called. RBI put forth certain kind of suggestions to the RBI, to suggestions in order to make the indigenous bankers so more stronger, which means the indigenous bankers should have their accounts audited by by certified chartered accountants. There are certain guidelines of fixed for indigenous bankers. Submit their accounts to RBI periodically. At a regular period, their accounts have to be submitted with RBI. And the indigenous bankers are declined to accept the restrictions as well the compensation from the RBI. Therefore, indigenous bankers remain out of RBI purview. The indigenous bankers are even neglecting, or they have kind of restrictions in the compensation to receive the compensation from the RBI, it seems. So the RBI doesn't give that much of importance to indigenous bankers. Development oriented banks. Historically, close association between banks and some traditional industries were there, like cotton textiles, jute textiles, and any agricultural related industries will had a good rapport with banks for their loans in the beginning. Banking has not been mere acceptance of deposits and lending money. Now, when we studied about what is banking, we would always study about it is all about accepting borrowings and lending loans. But the scenario of banks have completely and dramatically has got changed in recent days. It includes development banking as well. It includes lead banking scheme as well. In lead banking, it acts as a leader for the other banks. In lead banking means it acts as a leader for the other banks. For example, credit syndication, where if one bank requires a huge amount of money, if one person gives it to the bank, I'm sure that there are so many risks involved. For example, Mr. X is asking for crores and crores of money. Let us assume that 10,000 crores of money Mr. X is asking for his investment. If one bank gives loan to Mr. X, if suppose in case if he falls insolvent, or if he dies after getting the money, or if the amount, if the business that he starts is not viable enough in future, then the bank which has rendered money will have to suffer. So lead bank, what it does, it acts as an agent for the other banks. It collects pool of money from different banks. It acts as an agent. It acts as an intermediary between the collective banks, and it collects money on behalf of Mr. X, and it gives it, through which the risks involved for that 10,000 crore money is diversified. Now the risk has got reduced. So this kind of activity is called lead banking scheme. So it is one of the important element of oriented banking, and providing credit for development of the district and mobilize savings in the district. Mainly, the oriented banking is giving importance to the development of that particular area. So, providing credit for the development of the district is the main aim of oriented banking. Progress of banking in India. Banking, when we talk about banking, there were only few banks before 1980. So, Bank of Bombay, Bank of Chennai, it was like Bank Madras at that particular time. Only few banks were there, and they collaborated with each other. After the 1930, 1920, again it has got changed. Even 1934, again it has got changed. So, but in 1969, only four banks were nationalized. Now, when you study about the history of banks, it will be highly interesting to know how the banks have started, how did it work on, and how the borrowings were collected, and how the loans were distributed, were there any auctions in between. So learning the banking in India at the historical phase, it'll be always interesting. And branch expansion, Okay, banking gives too much of importance for increasing branches. The count has been given for your empirical evidence. It says that the increased branches, in the year 2016, it was 71,177, and recently government says that in 2021 it at least have to establish at least 15,000 branches in the financial year 2021. So basically now the importance is given to the branches. Okay, the population served by branches come down to 64,000 to 16,000. Now as the branches count is, yeah, keep on increasing, and the more number of branches is serving few number of people. At that particular time the consumers were more, the depositors were more in numbers when the bank numbers were very less. But when the bank's branches have increased in drastic numbers, and the population which is served per branch has come down from 64,000 to just 16,000 rupees. As I said before, rural branch office serves villages within the radius of 12 kilometers. Okay, only rural banks are having the higher, it covers a wide range of geographical area, which accounts to the radius of 12 kilometers. So banking in India, especially the rural banks in India, it supports villages and it gives access to their borrowings and deposits. What does the banking in India does? It mobilizes the deposits, and how does it mobilizes? It collects deposits from people and it gives loans to the people. So it doesn't mean that once we submitted the deposit the money in the bank, it doesn't mean that it would be lasting forever. No, it's not the case. Once it is deposited, the same money will be distributed as loans, and the interest for deposits will be very less than the interest of the loans. So what they do is that they give a few amount of interest to the save people who saved money, and they use those saved money to lend loans. This is how the banks work, and this is what we technically and typically call as deposit mobilization. Expansion of bank credit. Bank credit has to be given to the industries. Every 5 years, the the priority sector is being decided by the government. In the first 5 years plans, it was for agricultural and agricultural area, and in the second thing it was for industry area. So at this particular time, what is the area which is being given a high priority? After 2006, the high priority in India is given for MSMEs, micro, small, medium scale enterprises. So it is now the priority sector in India is about MSME. But these priority sectors will continue to change year for year. But banking have, as we discussed earlier, the oriented bank, it gives much of importance for the development of the country. When it concerns of development, it has to give money for the projects, government projects, and research and development of any government related projects and all that it has to give. So development oriented banking, through the emergence of development oriented banking, priority sector is lending. Progress of banking in India, the diversification in banking. Banking has moved from deposit to lending to, as we said before, banking, when we said banking, typically it was initially called as accepting deposits and lending money. Now it is not. The function of banks have got changed dramatically, and it was diversified, like merchant banking and underwriting. I tell you, merchant banking, what is merchant banking? It is called as lead managers who facilitates the companies when they issue shares. They act as intermediaries between the investors and the company, Assume that company ABC Limited is there, and there are so many investors in the market. So what merchant banking does is, merchant banking is a financial institution. Any financial institution it can be. It can be either bank or non-banking institutions. But normally now it is the merchant bankings of banks. So what they do is that they connect the investors and the company which are in the need of money. So either it can be discretional or not discretional. Discretional means the man who invests money will give you the guidelines how it has to be used. In non-discretionary, the person who has money will not discreate anything, which means he will not say anything about how it has to be invested. Then underwriting. Underwriting is a responsible bearing activity, which means before when we issue shares, it is a responsible for the underwriter to give assurance that all the shares will be sold. If it is not sold, the underwriter will take the risk of selling those shares. So underwriters are those who agrees to sell all the shares in the market. So the risk bearing capacity, he gets certain kind of amount from the organizer, from the investor. So merchant banking is a lead banker. Underwriting, it is a responsible bearing activity, that all the shares will be sold. Mutual funds. Mutual fund is a financial institution which collects the pool of investment from investors, and that invest in diversified portfolios, and they earn certain money and they give it to the um, investors. And mutual funds are also kind of discretionary and non-discretionary mutual funds are there, and there are many types of mutual funds. The broad-based mutual fund types are open-ended and closed-ended. Open-ended mutual funds, they do not have any maturity period, but closed-ended mutual funds are having a kind of um, maturity period. So mutual funds broad classification, in it has a mid cap fund, it has equity funds, it has growth funds, it has income funds, it has index funds. There are so many types of mutual funds, but the broad classification of mutual funds can be of only two. One is closed-ended, the other one is open-ended. Closed-ended mutual funds, they have maturity period, and open-ended, they do not have any maturity period. Retail banking, it's the banking services which are being done to the individuals like us. Okay. So it's normally like accepting deposits and lending loans, and those kind of banking is called as retail banking. ATMs, automated telling machines, and as we know it, it's quite familiar that we don't need tellers to give us money or to tell us how much money that we have in our account. We have ATMs which are highly integrated with the internet facility, and whenever we want, we can go and check what is there, what's happening with our account. So ATMs are highly automated teller machines. Internet banking, of course, once the banking services will have to be taking place only at the banking premises. Now the scenario has got completely changed. Once if you have internet and mobile phone or laptop, everything can be done at your doorstep as well. You don't need to go to the bank and visit physically over there. Venture capital funds. If I want to start a business, if I don't have money, I can seek the help of the third party. The third party will give money, will give me assistance to invest money, looking at the proposal that I have. If my project or if my business sounds effective and productive and profitable, they will invest certain amount of money in they'll put investment into my business. If I have a project, of investment, if I submit it to the venture capitalist people, they'll go through it. If they find it viable, if they find it profitable, if they find it, it can go for a longer period of time, they will give me certain amount of money. And if the project is for 10 crore, I'm not, so I'll not be getting that 10 crore at very first moment itself, the payment will be distributed in equal or unequal proportions. At first, they'll give certain amount. Once the project is started, they'll give certain more amount. And after the project is nearing to the final, they'll give certain amount, some certain more amount. This is how it works. And factoring. Factoring is a financial arrangement where the invoices are being submitted to the factor, which means there are three people involved: buyer, seller, and a factor. If I buy certain amount of goods, well, let us assume that I buy goods for 10,000 rupees from the seller for credit. I did not pay any money to the seller. The seller will write invoice to me, so saying that the money will be collected after a month. So first day of April it takes place. The buying and selling, it takes place at first April. If it is for 10,000 rupees, only 30th April I'll pay 10,000 rupees. It doesn't mean that in between the seller might not need any money. He may need money, but at that time he cannot come and ask me. But he can submit those invoices to a bank. So the bank which supports by the financial assistance is called factor. So it is factoring is a financial arrangements between buyer, seller, and a factor. So buyer submits, the seller submits the invoice to the bank, and the bank verifies the invoices, and it gives 80% to 85% of the invoice money to the seller. If 10,000 rupees is the amount in which the trade has happened, it will give only 8,000 rupees or 8,500 rupees to the seller. On the maturity period, which means on 30th April, it collects money from the buyer. Either from the buyer or the seller will take the responsibility. We call it as recourse factoring or non-recourse factoring. There are two kinds of basic kinds of factoring. One can be claimed and the other one cannot be claimed. And the certain cases, the risk will be resting with the seller. In certain cases, the risk will be resting with the factor. These are the services that bankings are doing now. The banking services has got dramatically changed, and the services have got diversified. Profitability of banks. The reforms have shifted the focus of banks from being development oriented to being commercially viable. As we said before, all the oriented bankings, they were concentrating more on the development oriented side. So they gave money to the development projects. But now the scenario in the market has changed, and they shifted their focus to be commercially viable, which means commercially successful. Initially, they were service minded. They were contributing so much to the development oriented projects through which the country was doing good. But now they shifted their focus, they shifted their drive from development oriented to being commercially viable. And prior reforms to banks were not profitable, and in fact made losses for being two reasons. Banks were very unsuccessful during the mid of 90s, due to the declining interest income and increasing cost operations. And these two are the major elements why banks in the 90s failed miserably. What are the reasons for their failures? Declining interest income was one of the following reasons why their interest income was declining. High proportion of deposits impounded for CRR and SLR. As we discussed earlier, cash reserve ratio and statutory liquid ratio have to be kept with RBI. Cash reserve ratio, it has to be kept in the form of cash to the proportion of their deposits collected. Statutory liquid ratio, that has to be kept as the cash equivalents to the RBI, and it will be given in the form of gold or any short-term financial instruments. So at that time it was very high, due to which the proportion of their deposits were submitted in CRR. when the proportion of the savings submitted in CRR or SLR, the fewer amount will be rest with the persons to lend money. So at that time, the interest proportions they receive from the lending will be very less. I hope you'll understand. I repeat once again, which means when the major portion is being submitted to RBI for CRR and SLR, only few amounts will be resting with the bank for giving loans. When the loans are the products of the banks. Loans are the products of the banks. When very few loans are sold, the interest that the banks are earning will be very less. So through which the interest income was have been declining during 90s. And the second most important is the political interferences. You know, if a bank manager was there, if he did not give any money, if he did not lend loan to someone else, if he goes for the recommendation to the politician might insist the manager to give money, through which the political interferences leading to the huge NPAs. NPA means non-performing assets. The loans which are not being paid on time, or which is not paid for a period of time, is called as NPA, non-performing assets. So due to the political interferences, many loans were turned out to be NPA, non-performing asset. It is a loss to the particular bank. So rising cost of operations, banks were insisted to open many branches. As we discussed earlier, branches are in very large numbers, and banks were insisted to open branches in the rural area, in the area where the population is high. So they started enacting, they started erecting uh, branches all over the world, all over the country, through which their operational costs have become very high. So this is what we discussed. What is the reason for the operational cost increase? The Narasimhan Committee in the year 1991, they gave why the branch operation cost is very high. Though one of the reasons are uneconomic branch expansions, they spent in a massive amount. They did not contract the amount they were spending. They spent a large amount of money for branch expansion. Second one, heavy recruitment of employees, more than the requirement of the employees. More than the requirement, the employees were recruited. The growing indiscipline and inefficiency of staff due to the emergence of trade union activities. When trade union takes place in a particular company, I'm sure in a company or a bank or in anywhere else, I'm very sure that the productivity will not increase, and there would be strikes in between. Even now and then, every time bank strikes, due to which there is an indiscipline and inefficiency of staff due to the trade union activities, low productivity. Even though employees are not working very well, they manage only few amount of customers. So it means that productivity, it means using lesser input, producing larger output. But if the inverse case is that the output is not quite good, but the input taken is very high, it means that productivity is not good. So these are the main reasons that Narasimhan Committee put forth in the year 1991 for the increasing operational costs. And the Narasimhan Committee gave some suggestions as well. Asset reconstruction fund has to be it took over doubtful debts. Asset reconstruction fund has to be given. This is one of the Narasimhan Committee suggestion, and SLR to be reduced and CRR to be reduced. As we said earlier, the SLR and CRR was the major proportion why the interest income has gone low. So the Narasimhan Committee took initiative in reducing SLR and CRR. Banks to get more freedom to set minimum lending rates. The lending rates are normally being set by government. But what Narasimhan Committee suggested was bank has to be given freedom to set minimum lending rates. Share priority sector credit reduced. Now, priority sector, normally priority sector will be decided by RBI through the monetary policies and fiscal policies. And now the current trend in 2020, the priority sector is MSME, small, medium scale enterprises. If the small and medium prices enterprises asks for money, the banks have to give it. Okay, so but the Narasimhan committee put forth a suggestion that the priority sector loan to be reduced from 10% to 40%. So if it is reduced and the proportion of money they have in the operation for the operation efficacy will be high. That's why these kind of suggestions were made by Narasimhan committee. NPA management, non-performing asset management. And there were certain recommendations for the Narasimhan committee to manage NPA of a bank. NPA in banks are loss, basically. It is like a bad debts. To tackle this, the government enacted the scrutinization and reconstruction of financial asset and reinforcement security act, which means SARFASI. In the year 2002 it was enacted. In SARFASI, there you can arrange third party to collect the debts. You might have heard about stories that where SBI has sought the help of TCS for collecting educational loans. So this is a typical example, SARFAI, how it works. You can seek the help of a third person to collect your debts. So SBI sought the help of TCS to collect its own debts, so that it can concentrate more on the operations. Debt can be collected by the third party. The third party will get certain commission from the SBI. So these are one of the suggestions that Narasimhan committee put forth. So enabled banks realize their dues without intervention of court. For each and everything, they don't need to go for a court and raise petitions. If the payment is less than 1 lakh, if the payment or if the loan is less than 1 lakh, you don't need to set a third party money collector. But then if it crosses more than 1 lakh, you can still collect those amount without the intervention of court, and this is the limit that they have set in SARFASI. So that's the non-performing asset management, and this is how it works. Enable setting up asset management companies to acquire NPAs of any bank or financial institutions. Asset management companies, which means the third party money collector, you can set if you want to collect your money. NPAs are acquired by issuing debentures, bonds, or any other securities. Even NPAs are being acquired by issuing any financial instrument which are basically long term. As a second creditor, that's what we mentioned. If SBI is a loan giver, it's a first creditor. The one who collects the money on behalf of SBI is called a second creditor. The second creditor can serve notice defaulting the borrower to discharge his liabilities in 60 days. It can issue a notice to the buyer saying that the money has to be paid within the stipulated period of 60 days. And if he fails, it can take the possession of assets. If Mr. X goes default in the loan payment, the third party creditor or the second creditor can go and possess the assets to the value of the loan. The borrowers have the right to appeal to the debts tribunal. If the second party, credit party, or the third party, if they take the money more than 70%, we can go to the debts tribunal for the reversal. It's still possible in Safari Act. Indian capital market. Now only we are moving on to the Indian capital market. Market for long-term capital is called as Indian capital market. and demand comes from the industry and service sector and government. In capital market, where the instruments which took place in the primary market is being traded and sold. Supply comes from individuals, corporates, banks, and financial institutions. Whoever wants to issue shares, they'll supply it out. People who are in need of money, which means who are in the need of shares to invest in their disposable income, they can go for it. The Indian capital market can be classified into two things: gilt-edged market. Gilt-edged market in the sense the market in which only the government securities and bonds will be traded. Gilt-edged market is the market where only the government securities, bonds, and government instruments only will be traded. Industrial securities market, where the new issues and stock market, IPO. We might have heard about IPO, initial public offerings, and it will take place in the stock market. So these are the Indian capital market overview. How does Indian capital market help in the development of the financial institutions? These are the developmental financial institutions are highly owned by national government. These three developmental financial institutions are basically of government institutions, and these contribute certain portion of money for the development of the country exclusively. It works very effectively in the developing countries like India. So development financial institutions are the institutions which gives money for the purpose of country development, and those will be basically of government regulatory body, government based financial institutions. The financial intermediaries are merchant banks, mutual funds, leasing companies, and venture capital companies. And these were discussed a little bit earlier. Merchant banks are the lead bankers which facilitate the issuance of shares, and they act as many. They do many kind of services like registering services, act as an agent, and they do take place of underwriters. They act as underwriters. So they do take many of the activities, so that they are called as lead bankers. Mutual funds, as we said before, it is an institution which collects the pool of investment from many investors, and it invests it in portfolio and gives the return on behalf of the investor. Leasing companies, the companies which help in hire purchasing and leasing. Venture capital companies, the companies which support in terms of investment. They'll look into your project and your project, your idea generation and your proposal, and accordingly they'll give you the investments. And you have to there are certain guidelines. In certain guidelines, they'll term out to be your partners, and they'll get the proportion of your profit. In certain cases, they'll get their money back with interest after a particular period of time. Simply, for your business, they'll invest their money for certain purposes. Industrial securities market refers to the market for shares and debentures of old and new companies. It refers to the market for shares only, shares and debentures only. New issue market, the place where it is called as primary market, the market at which the IPOs, initial public offerings, are take place. Stock market is also called as the secondary market. These are the securities which is already issued by the government, so already issued by the companies in the primary market. So primary market is a market where the financial instruments take birth. In capital market, where it is being traded and sold. So primary, where it is only created. Secondary market, where it is traded and exchanged. Financial intermediaries, we talked about mutual funds. Mutual funds are the financial institutions which mobilize funds. There are types of mutual funds called growth fund, income fund, and balanced fund. Growth fund, they'll be investing in the last point you can see growth funds, income fund, and balanced fund. And income fund, the money will be invested in the avenues which has fixed income. You know, the regular income like preference shares, like bonds, like debentures. They have regular, fixed kind of interest. So, our income, the income fund will be invested at which the amount is fixed, which means the return is fixed. Balanced fund, it will they have the proportion of equity funds, preference funds, and debentures. So balanced fund means, they'll invest your money where the equity shares and preference shares and bonds and equities are mixed together. So these are the types of mutual funds basically. Mm. Fourth point, it is their instruments at savers end are called as units. What is units? I'll tell you what is units. If I want 10 shares, I cannot buy it. If I want 7 shares, I cannot buy it. Or if I want only 17 bonds, will I be able to buy it? No. The bonds and shares will be sold and traded as units. If one unit is 100 share, you can only buy 100 share. You can only buy as units, not as 70 shares, not as 60 shares. So basically, mutual funds are being traded as units. So as we said before, what is investment? It pools the funds of savers and invest in the stock market. So that is what the meaning of mutual funds. It is regulated by SEBI as usual. Merchant banking, as we said before, manage and underwrite new issues. Underwriting is taking responsibility to sell off all your newly issued shares. Undertake credit syndication of credit. As we said before, if one person needs a large amount of money, I can act as a agent, and I can collect money from many bankers, and I pull it together and I give it to the person who is in need, so that the risk is diversified. So loan syndication is a process where the loan is collected from various money lenders and pulled it together and give it to the person who's in need. And the person who acts as an agent will be uh, you know um, the intermediary. That person helps in giving the money, and that process is called as credit syndication or loan syndication. And financial intermediaries are also subject to the regulation of SEBI and RBI. And SEBI regulates the issue of activity and portfolio management of their business. SEBI, whatever the stock market, primary market, secondary market related activities that will be done, that will be looked over by SEBI, Securities Exchange Board of India. So the conclusion is that there are financial intermediaries such as NBFC, non-banking financial corporation, venture capital funds, etc. And we discussed about venture capital funds, mutual funds, NBFC as well. India's financial system is quite huge and caters to the every kind of demand for funds. The financial system in India, it's very huge, and it serves as a backbone for Indian economy. Banks are core to the financial system, and therefore it's greater expectation from them in terms of reaching out to the vast populace as well as being competitive. Without banks, nothing can be done at this particular juncture. If 5 days at a stretch, banks are on leave, I'm sure that the total economy will face problems. Similarly, banks serve as a backbone of any country, which facilitates mobilizing the funds to one end to the other end, so that the financial system works so smoothly and effectively. With this, we discussed a lot of things like financial intermediaries, financial. So in this particular discussion, we discussed financial assets, financial institutions, financial markets in detail. So through which we discussed a lot of things, but then these are the things which will be helpful in clearing it. And these are only an attempt to brush up your, knowledge in banking and financial institution. I hope that you'd work further, and I wish the net aspirants wishing you all success. Thank you, everyone.